Candlestick patterns are an important part of technical analysis, helping buyers and sellers understand the market's direction and make informed decisions. By reading and understanding these patterns, traders gain a significant advantage, enabling them to accurately predict market movements. In this guide, we will thoroughly explore 5 of the most powerful candlestick patterns, learning how they work, why they are powerful, and how they can be utilized in your trading strategy. The first is the hammer candlestick pattern. It is a reversal signal. The hammer candle is a popular reversal pattern that forms after a downtrend. It has a small body and a long lower wick. This pattern forms when, despite a market decline, bulls have pushed the price upwards. Why is it powerful? The hammer pattern indicates that seller pressure has decreased in the market, and buyer pressure is increasing, meaning the trend is likely to reverse. When this pattern forms after a downtrend, it suggests that the market may rise. How to use it? Traders use the hammer pattern as a buy signal. When the hammer pattern forms, traders wait for the subsequent bullish candle that closes above the hammer candle's high. This confirms that the trend may move upward. The hammer pattern is more effective near support levels. The second is the engulfing candlestick pattern, which signals a strong trend shift. The engulfing pattern consists of 2 candles. Bullish engulfing occurs when a large green candle completely engulfs a smaller red candle. Bearish engulfing occurs when a large red candle completely engulfs a smaller green candle. Why is it powerful? The engulfing pattern indicates that a major change is coming in the market. The bullish engulfing pattern indicates that sellers have overcome buyers and the trend may start moving downward. The bearish engulfing pattern indicates that sellers have overcome buyers and the trend may start moving downward. How to use it? Traders use the engulfing pattern for their entry points. The bullish engulfing pattern is used as a buy signal when it forms after a downtrend or at a support level. The bearish engulfing pattern is used as a sell signal when it forms after an uptrend at a resistance level. The third is the doji candlestick pattern. A doji candle is a type of candle in which the open and close prices are almost the same. It may have a long upper or lower wick. This candle represents market uncertainty, where there is neither buyer pressure nor seller pressure. Why is it powerful? The doji candle indicates that there is no clear direction in the market. When a doji forms after a trend, it can signal a reversal, especially when the doji forms at a support or resistance level, making it even more significant. The fourth is the morning star and evening star candlestick pattern. Morning and evening stars are 3 candle patterns, which signal trend reversal. This pattern forms after a downtrend and indicates a bullish reversal. The evening star pattern forms after an uptrend and indicates a bearish reversal. Why are they powerful? Both patterns indicate that the current trend is weakening and a new trend may start in the opposite direction. The morning star pattern suggests that seller pressure is ending and buyer pressure is starting. The evening star pattern indicates that buyer pressure is decreasing and seller pressure is increasing. How to use it? The morning star pattern is used as a buy signal when it forms after a downtrend, and the evening star pattern is used as a sell signal when it forms after an uptrend. By identifying these patterns at significant support and resistance levels, the fifth is